Welcome to the deep dive. Today, we're taking aim at something that can be, well, way more destructive than market volatility.
Oh, for sure.
We're talking about human psychology. The sources we've got in front of us are basically a masterclass in prevention. We're going to dissect the anatomy of the worst trade.
Exactly. And these are the kinds of anonymous failures that just, quietly drain accounts, even when the trader's market analysis is actually brilliant.
That's the mission, then. We're getting past the generic advice.
Right. We want to pull out these universal psychological traps, what our sources are calling the cave brain response, that cause all this capital erosion. We'll look at where the process just falls apart.
And then we pivot.
And then we pivot straight to application. I mean, what does this tell us about right now? It's November 27th, 2025. Liquidity is pretty thin after the U.S. Thanksgiving holiday, and month end is coming up.
So we'll use our risk indicator suite to see if this risk-on strength the market's showing is real or if it's just, some kind of illusion.
That's the plan.
Okay, let's jump in. First, let's define the enemy. If process is the structure that keeps you alive in the markets, then the cave brain is what actively tries to tear that structure down.
It really is. The cave brain is just that evolutionary fight or flight thing taking over your complex decision-making.
And in trading, that means what?
It dictates two really destructive behaviors. If you're in a losing position, the cave brain sees that loss as, immediate danger. So it forces you to hold on, hoping you can escape back to safety.
Back to break even.
Exactly. You're just paralyzed by denial.
And what about when you're winning? Does it flip?
It flips completely. When you're in profit, the cave brain suddenly gets terrified of losing the gains you've made. So it makes you close the position way too early, and you kill your own upside.
So either way, all that sophisticated analysis you did to get into the trade?
It gets thrown out the window.
Yeah.
You've completely outsourced the decision to raw emotion. We really need to see this in action.
We have 3 case studies that show this perfectly. Let's start with the DAX short and what the source calls the 1 ATR trap.
Okay, so this trade, it had 2 layers of failure. One was technical, and the other was purely psychological.
What was the technical mistake?
The trader shorted the DAX when the index was already down 1 full average true range 1 ATR from the open.
And for anyone who doesn't know, ATR is basically just a measure of daily volatility.
Right. So shorting after a massive drop like that means you've entered at the point of maximum stretch. Statistically, you're just betting against a very high probability snapback.
You're literally trying to catch the absolute last tick of a big move down.
Exactly. I mean, unless you're in a real black swan event, that's the area where snapbacks are most common. And this is where the psychological trap springs.
Because the market immediately told him it was a bad trade.
Immediately. It was a terrible entry. The price moved against him right away.
But then something happened. He got a lifeline.
He did. The DAX just drifted back up and returned to his original entry price. He'd shorted the literal bottom, and the market gave him a golden ticket out.
A chance to just scratch the trade, walk away flat, and save his capital for a better setup.
Yeah.
So why didn't he take it? What was the cave brain telling him?
Greed and ego. He saw that return to break even not as a lucky escape from a bad trade, but as a sign that his original idea was still right.
So the market was just giving him a second chance to be proven correct.
That's how he saw it. So he held out for his original huge profit target, which was based on that flawed breakout idea to begin with. The market, of course, reversed hard again, blew past his stop, and it was a catastrophic loss.
Wow, sacrificing real capital to protect his ego.
Instead of just taking a free exit.
That sets us up perfectly for the Bitcoin example. This one sounds like pure ego defense. The revenge trade cycle.
It's such a classic sequence. You see it all the time. So a trader has a good win. Let's say he shorts Bitcoin at 93K, feels great, he's a winner. Then immediately after, he tries to catch a falling knife with a long trade, and it stops him out. Wipes out the first win. His P&L is now flat.
And the brain just can't handle that. It remembers the feeling of being a winner just a minute ago, and now it's back at 0.
The ego rebels. The response is just immediate, irrational FOMO, fear of missing out, and this desperate need to get back to that winning state.
So he jumps into a third trade.
A third trade driven entirely by his P&L, not by the chart. And of course, that trade starts losing right away.
What's the point of no return here? Where does it really escalate?
It's holding the loser. The sources say he held this clearly losing position for an hour, just paralyzed. But the ultimate denial, the real moment, was when the price got near his stop loss.
Let me guess. Instead of taking the loss,
he added to the position. double down.
Oh, trying to save it.
Trying to save it. And that right there is the definition of emotional denial. The second you try to save a trade, you're admitting your process has failed and you're just betting on hope.
And hope is not a strategy. Which brings us to case study 3, USD-JPY. This is more of a slow-motion disaster caused by that hope strategy.
Yeah, it's less dramatic than the Bitcoin one, but it's just as deadly to your capital because of the opportunity cost. The trader shorted USD-JPY based on a well-known theory. Big gaps on charts tend to get filled eventually.
Okay, but if the theory is statistically solid, why is getting in early such a huge mistake?
It's all about the timeline and the capital. Here's the reality check from our sources. With these massive gaps, like the one we're seeing now in USD-JPY, the price can run another 800 to 1,200 pips away from the gap before it even thinks about reversing.
An extra 1,000 pips.
And critically, that reversal process can take 6 to 8 months.
Wow, so you've got capital just sitting there, losing money for maybe half a year or more, all based on the hope that the chart will eventually do what you think it will.
Precisely. You've tied up your capital for maybe 3/4 of a year in a losing trade. And the psychological pain of watching that red P&L for months, it just inevitably forces a panic exit.
Right before the real move finally happens.
Almost always.
Okay.
And the cost isn't just the loss you take, it's the cost of all the good trades you missed while your money was tied up in that hope trade.
So the cave brain makes sure we buy late, sell early, hold our losers too long, and cut our winners too short.
Yeah.
Okay, if that's the problem, the solution has to be a rock-solid process.
It has to be.
Let's shift to the 4 pillars of success that the sources define. These are designed specifically to take emotion out of the equation.
Absolutely. The 4 pillars are just a framework for objective mechanical action.
Okay, pillar 1, edge.
Edge is your input. It's your setup. The thing that, when you test it, gives you a high expected value, a statistical edge over time. It could be inside bars, a 6-week cycle, a moving average crossover.
Anything, as long as it's defined and mechanical.
It has to be. It's the why behind your entry. You have to know it before you even think about clicking the mouse.
Pillar 2 is risk.
Risk is about the environment. Before you do anything, you have to ask, is the market trending? Is it in a range? Is volatility high? Your answer dictates your position size, your stop loss, how you scale in or out.
It's the structure that protects your money, win or lose.
100%.
Okay, pillar 3, execution.
This is just the mechanical act. It's the physical click of entering, exiting, scaling. It has to be done without hesitation.
It's the servant of the first 2 pillars.
Exactly. It's the obedient servant of edge and risk. If you pause, if you stop to think, should I press the button? You've already let the cave brain in.
And that leads to pillar 4, psychology. If edge tells you when to buy and risk tells you how much, what is psychology's job?
Its role is purely defensive. It's the protector. Its only job is to guard against the errors we just talked about. It makes sure that when you have a few losing trades in a row, you stick to the plan defined by edge and risk.
And critically, it must never be allowed to make the decision.
Never. If you use your fear or your greed to decide on an entry or an exit, you've just replaced your edge with emotion. And failure is basically guaranteed at that point.
That distinctions psychology as a protector, not a predictor, that's huge. Okay, so with that objective mindset, let's apply it. What does the risk indicator suite tell us about the market right now as we close out November?
Well, the current suite is pointing very strongly to a bullish risk-on bias heading into December. The momentum looks real. It's not just thin holiday trading.
Okay, so let's start with real yields. They're just under 1.8%. What's that signaling?
So real yields are your return after inflation. When they dip, especially while stocks are going up, that's a classic risk-on signal.
Why is that?
It means the return on safe assets, like inflation-adjusted bonds, is falling. So holding cash becomes less attractive. It encourages capital to move out of safety and into risk assets.
Into equities.
Primarily equities, yes.
And what about credit spreads? That's the difference between government and corporate bond yields.
Yeah, they had been widening, which is a bad sign. It signals stress. But recently, they've hit a clear ceiling and are starting to consolidate. That suggests the market is getting less worried about corporate defaults, which is a huge plus for stability.
And you pointed out a really interesting correlation with Bitcoin there.
Yeah, it's fascinating if you think about why big money moves. You see these massive spikes in inverted credit spreads.
Which means the debt markets are totally out of whack.
Totally. And those spikes often mark a macro bottom for Bitcoin because institutional traders, they're anticipating a huge market shift, and they rotate capital out of traditional bonds and into high beta assets like crypto before the main risk-on rally gets going.
And what we're seeing now suggests that initial panic is over, but the positive mood remains.
Exactly.
We're seeing this confirmed in other metrics too, like market breadth.
Yes. Market breadth, the percentage of stocks above their 50-day moving average, is moving up firmly. It shows the rally is broad. It's not just a few big tech stocks pulling everything up.
And your proprietary indicator.
Our bottom caller nailed the S&P 500 floor last week, so that just reinforces the idea that the immediate low is in.
Okay, so given this risk-on signal, let's get into the outlook for the next few weeks. You're targeting a rally into mid-December.
I think so. The indices look structured for more upside, probably until around the 16th or 17th of December. The DAX is broken out of its 6-week cycle, and I don't think we're going to see that tunnel 4,800 level tested again anytime soon.
And the S&P 500, you mentioned it's tied to a 75% time level. For anyone who hasn't heard that before, what does it mean?
It just refers to where we are inside a predefined time cycle that we use to measure rallies and corrections. The S&P bounced cleanly off its 75% time level, which was near 6,600.
So the correction finished on schedule?
Pretty much. The primary trend, which is up, has resumed. We're pushing towards 6,800 now. And same story with the NASDAQ. The 6-peak cycle analysis we used confirmed it refused to break down from that 24K support level. All signs point up.
Okay, let's turn to commodities. Gold is at 41.55 and just not stopping.
It's relentless. We have long positions from way back at 3,300 that are still running. No signs of fatigue at all. It just confirms that long-term bullish shift.
But oil, on the other hand, at $58. The chart looked bullish, but the source said scratch the trade at break-even. Why?
This is a perfect example of Pillar 2 risk overriding Pillar 1 edge.
Okay.
The chart looked good, yes, but the geopolitical environment is just too unstable. You have two huge policy risks. First, the risk of a conflict between Venezuela and the U.S.
Which would cause insane volatility.
Right. And second, the constant threat of the U.S. government releasing oil from its strategic reserves to push down inflation. That kind of policy move can just instantly vaporize a technical setup.
So when you can't predict the fundamentals, you take the risk off the table.
You have to. We eliminated the unknown risk and scratched the trade flag. That's capital protection.
It is. Now, FX, the yen pairs. You're saying there's a massive opportunity setting up, but patience is everything. This feels like the ultimate test against that hope strategy we talked about.
It absolutely is. I mean, the potential reward here is huge.
Yeah.
USD JPY is trading at 156.30, but there's this gigantic open gap way down at 147 that needs to fill.
That's almost 1,000 pips of downside.
It is. And Euro JPY is similar. There's an open gap at 173.36, which is about 400 to 500 pips of potential profit.
So we have the edge, the eventual gap close, but we're just missing the risk trigger.
Exactly. If you short it now, you risk falling right into that 6 to 8 month hope trap. The risk-on environment could easily push these pairs another few hundred picks higher before the real turn. We have to wait for a true risk-off trigger, a geopolitical event, a big Fed policy shift, something external.
Patience is protecting your capital.
That's the whole game.
All right, finally, crypto. Bitcoin is forming a floor, but you said the real line in the sand for the entire altcoin market is stablecoin dominance.
Yeah, Bitcoin looks okay. It's finding a floor above 82K, though a dip to 78K, maybe even 70K is still possible. Solana's actually the bright spot. It bounced hard off 124, it's near 140, and it's been picking up market share while BTC and ETH were lagging.
But for the whole structure to be safe, you need to watch that stablecoin metric.
You have to. Stablecoin dominance. It's just the percentage of the total crypto market cap that's held in stablecoins. The 9% level is the line in the sand.
What happens if it goes above 9%?
If dominance pushes above 9%, it means capital is fleeing altcoins into panic and parking in crypto cash. It signals a proper meltdown. Extreme de-risking.
And where are we now?
It just touched 9% and it's pulling back down. That confirms that as long as we stay below that level, the immediate risk of a total collapse in the alt market is, for now, contained.
Okay, that is actionable data. Let's wrap this deep dive up. 4 core takeaways for everyone listening.
Okay. First, you have to defend against the cave brain. If a trade goes 1 ATR against you and you get that golden ticket out at break even, you take it. Don't trade your ego.
Second, the objective data from the risk suite says the path of least resistance for stocks is up. We're expecting this risk-on rally to continue into mid-December.
Third, manage your patience on the yen. That 1,000 pip drop to 147 in USD JPY is coming, but shorting it now is just a costly emotional play. You have to wait for that external risk-off trigger.
And fourth, the crypto safety line. Keep your eye on 9% stablecoin dominance. Below it, the market can hold. Above it, capital is running for the exits. So here's the final thought. Given this bullish bias the market is clearly showing, if you're listening right now and you're holding significant short positions, you have to really hold your process to account. Are you fighting this risk-on tide because of a subjective impulse or an emotional attachment to an old idea? Ask yourself, how is your adherence to the 4 pillars edge, risk, execution, and psychology? How is it shielding you when the entire market is moving against your deepest emotional impulse? The successful trader, well, they use process to withstand the market, not emotion.